Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record a video per week, so make sure you ring the notification bell to get notified each time one comes out. Navigating the stock market requires understanding its natural cycles and maintaining a long-term perspective. This video delves into key concepts such as the inevitability of bear markets, the benefits of volatility, and cyclical nature of the market trends. These are some things that I learned about the stock market over time. By grasping these principles, investors can develop a sound strategy to achieve long-term success. The stock market can feel like a roller coaster ride with periods of exhilarating growth followed by stomach-churning dips. While these downturns can be nerve-wracking, historical perspective can help you weather the storm and stay focused on your long-term investment goals. This video explores 5 key concepts that every investor should understand to navigate the stock market's natural cycles and maximize their chances of success. We'll delve into the certainty of bear markets, the link between volatility and higher returns, the cyclical nature of market trends, the importance of holding on for the long term, and the challenge of actively picking stocks that outperform the market. By grasping these principles, you can gain clear-eyed understanding of how the market works and develop a sound investment strategy for the future. So here are the 5 key concepts to remember when investing in stocks for the long-term gains. Concept number 1, embrace bear markets as stepping stones. Bear markets, periods of significant price decline, are expected. However, they tend to be shorter than bull markets, which are growth periods. While these downturns can be nerve-wracking, remember, panicking and selling can lock in losses. A long-term perspective helps you weather these storms and capitalize on future opportunities. Concept number 2, volatility can create opportunity. If the stock market, S&P 500, only experienced steady growth, its returns would be similar to those of a deposit account or short-term bond due to the limited risk. Thankfully, the market's unpredictability and occasional major declines enable it to offer higher returns over the long term. This phenomenon is known as the risk premium, and it's also significant during certain high-impact events. Ultimately, there's less downs than ups. So as long as you don't sell in the middle of a down market, and ideally you actually buy during those opportunities, you'll be fine. Concept number 3, everything is cyclical. Howard Marks aptly describes market movements as a pendulum, swinging between extremes rather than settling in the middle. This cyclical nature means that after periods of strong performance, markets often experience downturns and vice versa. During bullish phases, valuations soar and investor sentiment is euphoric, driving prices higher. However, this exuberance sets the stage for lower future returns as valuations become stretched. Eventually, the market corrects, prices fall, and fear replaces euphoria. This correction paves the way for the next cycle of growth. Understanding this pendulum effect can help investors navigate market cycles more effectively, allowing them to anticipate shifts and adjust their strategies accordingly. As an aside, it is an interesting study in psychology how a stock or house or car that everyone loves makes you feel ecstatic about it, and then when people stop liking the exact same asset, it somehow loses value. Concept number 4, time and patience are crucial. Want to make money in the stock market? Success requires time and patience. The longer you hold stocks in your portfolio, the higher your chances of making a profit. Currently, the average holding period for stocks is just 6 months. This short-term approach often leads to financial losses, as illustrated. Most investors fail to make money because they bet against the odds. If you hold a US stock for 20 years, statistically, you don't lose money, and you get a nice annual return instead. And finally, concept number 5, can you beat the market by stock picking? Stock picking to outperform the market is possible, but it's a formidable challenge. Nearly 90% of active managers fail to beat the market over periods longer than 3 years, despite having access to money, information, and skilled teams. So can individual investors do it? Maybe. Keep in mind that out of the 500 companies in the S&P 500, about 151, so roughly 30%, typically end the year with negative returns. Only a few significantly outperform the market. What are the chances of picking those 20 to 30 stocks that will yield substantial extra returns? Slim. As Warren Buffett said, investing is simple, but not easy. Everyone knows what would be the right thing to do, but very few do it. This has been the top 5 things that I learned from the market. Please tell me anything that you feel I missed or that you learned in the comments. If you have any requests for what you'd like me to cover in future videos, please put that in the comments section. If you'd like to get in touch, please reach out on any of the social media channels, and may you have a profitable day.